So without any further ado, I'd like to welcome Chris Devore. Everyone stand up and give him a shout out.
Really?
Yeah, really.
Really? Is this me? All right, good.
Really? He was so excited about that part. He's like, I cannot wait till you get to do that, Mike.
Thank you.
Yes, you're welcome. Well, thanks for being here, Chris. It's always nice to have you. It's great to see you. You know, he was at Startup Grind probably 6 years ago.
I definitely did one. It was down on the waterfront.
Yeah, it was down on the waterfront.
So it was
a few years ago.
This has become like a global thing since then. So
it was
just
a few things.
Me and you sitting up here chatting and like 600 other things around the world. That's pretty cool.
Yeah, it's totally cool now. So thanks for being here, and and also I just want to say thanks for the effort and work that you do in the community. It doesn't go unnoticed. So I just got to say thanks. Keep it up, man.
I think everyone in the room is doing the same thing, right? We're all just doing what makes sense to us and what we like to do, and so people say that to me, and I'm like, what do you mean? I'm not doing any more than you are, and probably less. So we're all just doing our thing.
Stuff, yeah. Well, so I love to talk about a couple of things. Definitely, kind of the exiting of Techstars and how. Let's talk. We'll spend some time about how we even get to Techstars for other companies, and then also, the funding that you're doing through Founders Co-op and where that's going to go and kind of the future of that. So, why don't you give everybody just a short elevator pitch of Founders Co-op?
What I do.
Yeah,
right,
exactly.
Yeah.
What the hell you do?
Good. Yeah. No. I think when we set this up, I was still running Techstars, so that's a change since. So really quickly, for those who don't know, I run a seed stage venture fund called Founders Co-op here in town. We're currently investing out of our fourth fund. It's a $25 million fund. So I started it in 2008, so more than 10 years ago. And then in 2010, my original co-founding partner of the fund and I started running Techstars in Seattle. And so I just, after 10 years of being involved with Techstars this year, decided it was time to pass the torch on that. So how many people know what Techstars is? Good. Mostly, I don't need to explain what Techstars is and does.
Yeah.
What's fun, I was telling somebody a little bit earlier, Techstars sort of started, we were the third program ever of Techstars. It was Boulder first, and then Boston, and then Seattle, and then New York. And so Techstars is now more than 50 programs worldwide. We've got like 1,500 alumni.
Yeah, and they own Startup Week.
Kind of like Startup Grind. It's turned into kind of a thing.
Yeah.
But it was really fun both to see Techstars grow up and to see Seattle grow up alongside it. And I feel like those two things happened together.
Yeah.
So I'm proud of what our city has become, and it's been fun to play a small part in that, but with both Founders Co-op and Techstars.
Yeah. No, it's been great. I mean, what's happened over the last 7, 8, 10 years is truly amazing, right? Like just what it's grown to. So talk to us. How many people would want to be in an accelerator? Raise your hand. How many people have been in an accelerator? Anyone in the room been in an accelerator? So why don't you give us the pitch, the reason why you would ever want, why would you even want to be an accelerator? Like you and I started a company, why do we want to go to accelerator?
I mean, I can give lots of reasons why, but I'll give you the main reason why, because it's expensive, right?
Yeah.
From a cap table standpoint, whether it's Techstars or YC, it's going to cost you. And the main reason why is the eye of the needle for raising institutional venture is incredibly small. And if that's something you think you aspire to do as a firm, I think having an unfair advantage of getting access to the institutional capital markets is something that's worth doing.
Yeah.
My goal when I was running Techstars Seattle was to get at least half of the class, so 50% of the class, to an institutional financing within 6 months post-program. And I think most startups, like the idea of ever getting access to the institutional markets are like one in, pick a number, but it wasn't 50%.
No.
So I think that was the trade, which is if you think you want to get access to institutional capital markets, we can help you do it. We have a track record of doing it. We've demonstrated a track record of success.
Yeah.
And if that's what you aspire to do, we'll give you an unfair advantage. There's lots of other benefits besides that. Mentorship, and we have some great mentors of ours who are here in town. I'm looking at you, Dan Delmar. I think having a cohort of high-performing peers is really powerful. Like it can be really lonely to be a founder and to have 10 other companies around you that do amazing work and inspire you to do amazing work. Like that's a lifetime gift. But I'm just giving you the number one reason to do it. If you think you don't want to do it and you think you're going to go raise institutional VC on your own, go get them.
Good luck. Yeah, it's not easy. And in that environment of the accelerator, right? In that environment of, high performing humans, high performing teams, hopefully. Where do you think? What are the things that you've learned that you think are kind of keys to being successful through that accelerator? Like, what makes, like you and I start a company again in that scenario, what makes us more successful to get through that, like at the end of the day?
Yeah, I mean, I'll give you a heuristic that we use in selection. And so anybody who's applying to Techstars, be aware that this is a heuristic that will be applied by Isaac Cato, who's the new MD, and any other program you're applying to, is founders have to have a really unusual, it's almost like a schizophrenia, which is they have to have a ridiculous sense of internal motivation and self-confidence that they think they know something that other people don't know, and they're going to go do it. Like the world's telling them they're wrong every day, and they're like, no, I'm right, and I'm going to do it.
I got it.
And they have to be humble enough to be coachable and to be, when someone tells them they're wrong, to be able to filter that and be like, oh, I can see, like, I still believe in this thing, but what you're telling me really makes sense, and I need to recalibrate. And a lot of founders have one but not the other. Right? Yeah. Either they're convinced that they're right and they're not going to take anybody's feedback and they're going to go right off a cliff,
Sure. Or
they're so uncertain that anytime the wind blows on them, they change direction. And it's really tough to be both at the same time. And I think so coachability is something it's what we call it at Techstars is coachability.
Yeah.
You're absolutely driven and passionate and focused on something, but your ears are open enough that when a mentor says, you have your head so far up your, you know what,
yeah.
They're like, oh, interesting. Like, tell me, like, they don't get mad, they don't get defensive.
Yeah,
they'd be like, oh, why do you think that?
Yeah.
And that's a superpower.
Tell me more.
Yeah.
That's the superpower.
Yeah.
Because it isn't normal. I mean, to have both those traits, it's not normal.
No, it's not.
Yeah,
exactly. Founders are not normal, just to be clear.
Just FYI.
Yeah.
Yeah, we all know that.
Yeah.
So funny. And what are the things that, like getting back to like where you've grown from, what are the things, like what have you changed from, say, 8 years ago when you started to now? Like what have you, what's Chris gone through?
Yeah, no, I mean, it's a great question, because I think most people who are drawn to this work are learners, right? They're lifelong learners, and if you stop learning, you start to feel stuck.
Yeah.
And one of the things that's been really fun for me, having been a founder, some success and some failure, right? So it's like, I know what it's like to be in that seat, and then starting a fund to try to figure out how can I actually, because as an investor, you don't control anything, right? You own a little bit of some equity in, but you can't tell people what to do. Yeah. So how do you try to help people with that work? And then, if you're trying to build a fund business, because I never thought I'd be a money manager, but fundamentally, I run money for other people, right? Exactly. That's a whole nother can of worms, which is like, how do you raise money, and how do you manage money, and how do you drive return, and how do you be a good fiduciary? So it's sort of fractal. There's the work of working with founders and help people start companies, but then there's layers and layers on top of that. And so there's always new stuff to learn and new people doing it better than you that you can learn from.
Yeah.
So I think what I like that about it is you've got, rather than one company that you're just laser focused on making successful, you learn across a spectrum of companies that you work with, and you learn about the meta layer of the business, and there's sort of never a dull moment. I mean, I think Brad Feld has an expression which is, something is fucked up in my world every day, which I really appreciate, because when you've got a surface area, there's always gonna be stuff that's going great, and there's gonna be stuff that's going terrible, and so you have to figure out how to just kind of absorb that and deal with it. But there's never, ever, ever a dull moment.
Yeah, it's never like wake up, it's like, same things yesterday.
No, right.
It's always going to be something wacky going on. And who are some of your favorites, Chris? Like, who are some of your favorite, from the VC side that are, publishing blog stuff, or whatever, pushing out content? Who are some of your favorites? That again, you and I started a company. Who are like, Mike, you should take a view of these 2 or 3 or 4 people.
Right. I guess I would say one thing that's changed the most about this whole world since when I was starting out, you were starting out, is everything is open source now. It feels like. I would say honestly the single place that does the best content on almost anything is Y Combinator. And I think YC publishes amazing stuff about financings, about the founder journey. Their content factory is the highest quality, and they've got enough data for it to be really, really good. The pioneering VC bloggers were Brad Feld and Fred Wilson and folks like that. And I feel like those guys are sort of fading into the background now. And there's a whole nother generation of people coming up. And it's almost, there's too much content to try to figure out. And I think a lot of it has to do with what geography you're in, what stage you're at, and what kind of investor speaks to you. I mean, there's the whole other category is, we're talking about mostly guys, and now there's more people of color who are investors, there's women who are investors, and I think that's also because there's lots of things that were not obvious to middle-aged white male investors
Sure.
there were huge blind spots.
Yeah.
And now there are people who are Elizabeth Yin is somebody who's got a new she's amazing, a new fund called, and she talks about being a founder and an investor and a woman investor, like Aileen Lee at Cowboy, who sort of coined the unicorn thing, like she's been hugely influential. So I think the diversity of voices is probably more interesting than any single voice.
Yeah.
And that's also changed a ton in the last 5, 7, 10 years.
Yeah, I agree. I think that probably is the key, is there's so much different viewpoints now, because 10, 12 years ago it was 35-year-old white guys.
Yeah.
I mean,
and they're all 50 now.
Yeah, exactly. So now you've got all these different viewpoints, which are great because you get different viewpoints.
Yeah.
It's like,
and also I think different. So it used to be everything was Bay Area centric. I mean, Fred was New York, but now it's like LA's got a thing, and Austin's got a thing, and Chicago's got a thing, and they all have their own flavor. And I think the geographic diversity of innovation has also been really fun.
Yeah, and then you got like Tel Aviv, and you got these other.
Yeah, globally, yeah, it's amazing. Yeah.
Yeah.
I think, and for me, one of the fun things about Techstars, because it was sort of the anti-Bay Area, is there was a little bit of a chip on your shoulder, but I think in a positive way, which is not every smart person in the world lives in San Francisco, right? There's a lot of really smart, capable people who have chosen other places to live, and they deserve high-quality advice and investment support and co-founders and all the rest of it. Like and so my work is about the Pacific Northwest, and I believe you can build, and people have shown you can build really valuable, impactful companies in places other than the Bay Area. But that idea that innovation can happen in lots of other places is another sort of thing that didn't seem true a decade ago. And now people are like, oh, of course, like that's obvious now. Well, it was not obvious 10 years ago.
Yeah. I mean, you think about our conversation, even 7 or 6 years ago when we were talking of the same stage, we were talking about there's no angel investors, there's very little money, all that was Seattle, right? That's the way it was.
Yeah.
I mean, and now it's hard to say that.
Yeah, I mean, we've got
still
some
behind.
work to do, to be honest.
Still behind. Yeah.
No, but I think it's gotten way more, everything about Seattle's gotten more liquid. And a lot of that's Amazon growing right downtown. I mean, I think the decision for them to commit to the downtown core is probably even more than Microsoft kind of under Satya getting its groove back on out in suburbs, is a suburban innovation cluster made a very diffuse ecosystem. And I think, frankly, this is true in the Bay Area, too, that stuff is happening up and down the valley. There's been a real concentration up into the city. And I think that density, so then you get Facebook and Google setting up shop down in South Lake Union and Pinterest downtown. And all of a sudden, we've grown our own companies. You've got, let's think of Zillow and Tableau, which is, of course, is Salesforce now, and Smartsheet. Like, you have companies that actually grew up here. Yeah. You've got imported companies, and you start to have a real liquidity in the market where if you don't just have to work at Amazon or Microsoft anymore. And if you move up from the Bay Area, you don't feel stuck anymore. You can work with a Bay Area company, you can work with a local company, you can start your own thing. Yeah. So it's just the velocity and liquidity of our market. Because my work is a derivative of that. Most people come here to take a job, not to start a company, which I wish were different, but that's the truth. Yeah. But inevitably, 1 to 5% of the population is like, I'm sick of working for that guy. I'm going to do my own thing, and I hope they call me when they do, because inevitably, people pop out, and the quality of people in Seattle and the diversity of people is so much greater than ever was, that the kind of founders that we now see up here they breathe fire. They're way more ambitious and hungry and want to play at a bigger level than they used to back in the day.
I think that's the thing. Bill Bryant was talking about that a year ago, that Seattle founders need to take bigger swings. They need to take more home run swings, right? Yeah.
Well, it helps to see people doing it, right? Like, not like, oh, let's get it to 50 million and punt to somebody, but it's like, no, we're going to go all the way and actually pull it off and have it work. And you got
Nick Huser now, you got Vermetley doing it.
Yeah,
Matt.
It's working.
It's working.
Right.
And like, where do you think are in your opinion, what are the strong suits of Seattle? Like, just give us your opinion on strong suits. I know you're not afraid to give your opinion. So what's your opinion on strong suits of Seattle?
So I think, and this should be obvious to everyone in the room, right? This is not something you haven't heard before, is if you assume that the corpus of talent is your bedrock, and you're stripping off free radicals from the talent pool, whatever your talent pool is awesome at is where you're likelier to find the best stuff. So it shouldn't be a surprise. Enterprise software, cloud infrastructure, developer tools, like that is right over the home plate for us up here. Consumer internet, branded internet, media and ad tech, not so much, right? Not that it can't be done, and it has been done, but it's not really the center of the target. the stuff that I think is interesting for everyone in this room is to think about, sort of look over the horizon aspirationally. Like Seattle probably has the largest pool of machine learning and AI talent of any major market anywhere, because a lot of the cloud infrastructure teams, like a lot of those people were up here. Yeah. Facebook set up shop up here in part because they wanted to recruit. Like Oronezione's mad at hell, and Lazowski's mad even madder that they keep stripping people out of CSE and out of AI squared and places like that. Yeah. So if you think about applied ML or voice, or another one that I think is really interesting is Seattle has a strong history of healthcare, but the healthcare and software innovation communities have usually not crossed over. But now I think with stuff that's happening at Institute for Protein Design and UW campus, the application of data and machine learning to life science problems. So like there was something called A Alpha Bio, you guys probably saw, just announced a financing recently, where they're using basically machine combinatorial math to try to figure out pharma pathways more like, so using software and machine learning to try to come up with better pharma, shorter, faster paths to pharma. Yeah. That's the kind of thing that I think is interesting, is think about not only what are we good at today, but what are other pockets of excellence around here, and if you combine those in productive ways, where should the puck be going? Not wishfully. Like there's this thing about Seattle should have a fintech landscape. It's like, well, should, like where's that coming from? Like sure, Remitly is awesome, and maybe if you squint, Avalara's a fintech company, but you can't will that stuff into being. You need amazingly talented people that are the best at what they do, banging their head against the wall in directions where they can work with peers equally talented as them in life sciences and machine learning. That kind of a thing is where, as an investor, I'm like, oh, we should be seeing high quality stuff here. Let's go muck around.
Yeah, I think one of the things you just said there is important, is you're looking where the puck's going, not where the puck is.
Well, we were also joking earlier with some folks, which is like, what are investors excited about now? And the joke is investors are excited about whatever made somebody else money 5 minutes ago, right? and founders too. Founders are just guilty, which is like, oh, it's like Facebook just went public. I'm going to start a social network. It's like, fellas, that ship sailed 10 years ago, right? Like you gotta be like look around the corner a little bit.
Yeah, and it's being able to look ahead and seeing what other people don't see. Hence the reason some people
and being wrong a lot, because that's the cost of that. Is most people's crystal ball is pretty cloudy, mine included.
All of our crystal balls are pretty darn cloudy. And where is the for Founders Co-op? Let's talk a bit about Founders Co-op. Where is the big? I call it the big opportunity for what I would call a small fund.
Yep.
No offense.
No, that's true.
Like, where's the opportunity for a small fund? Do you think there's more funds going to be coming to Seattle, or even having people in Seattle, the smaller funds, or it's these big, $500 million funds? I mean,
so I learned a ton about this in the last 10 years, trying to figure out how to build a fund and raise funds and all this. And I think the main thing I've taken away is capital tends to be sticky in geographies. Right, so Wall Street is Wall Street for a reason. There isn't another Wall Street in North America, nor will there probably ever be. So anything about late stage and public finance, like New York's pretty much what you do. Sand Hill Road is the Wall Street for innovation finance, and that's what asset allocators want, meaning like big pension funds and university endowments. Like they're mostly going to put their money in the Bay Area because they believe that those managers are the best managers for that asset class. So you don't have a lot of asset allocators looking to deploy capital to managers that aren't in a money center.
Gotcha.
That doesn't mean that there aren't great innovators in other geographies. So the question is, how do you match up the high-performing founders in geographies that don't have money with the people who have the money, which is usually the Bay Area and New York? And the short answer is the first check is always, and this is our thesis as a fund, the first check is always local. Because the big guys can afford to hang around the hoop and wait till something shows some promise. But the local market, and that's local angels and local funds, are the ones that have to stick their neck out for the first check. And the Valley Series A market will sit and wait, and they're happy to pay up. Like they run so much money now, they don't mind, and the prices they're paying these days are pretty stupid. But there's no leverage in their model to take a bunch of early risk and have such stuff break on them. So if you're in the first check business, you can do that business well in a second tier market. Seattle's a second tier market, right? So if you're in Seattle or Austin or Chicago or even like LA, Atlanta, you can do really well. But the minute you raise more money and try to compete with the Valley, you are fucked. You're done, right? So that's my job is not to forget that and make sure my fund is appropriately sized to be the first best check in my market for the guys who will get their Series A raised in the Valley.
So that's your model, right? And do you think there's any hybrid models in there? That bigger guys can play in that smaller field, or is it just not possible? I mean, they can do it.
Define hybrid model. Because I'm seeing lots of, like, in late stage, we're late in the cycle, right?
Yeah.
Late in the cycle is whenever you see the tourists come back, right?
Sure.
And so the corporate venture capitalists get bulk up, and you see, like, I shouldn't even say this out loud. You see alternative founder models, right?
Sure.
Where it's not a founder-driven model. It's somebody with some ideas and some money, and they try to get someone else to work on their ideas so they can sit back and let the magic happen by somebody else doing the work.
Yeah.
And that is just not how great companies get built.
Yeah.
Great companies are built by founders, and you forget that at your peril. And no amount of, like, corporate venturing or, like, recruiting mid-career executives to come work on your shit that's not how the Amazons and the Microsofts and the Salesforces and whatever else get built.
Yeah, because the passion's just not there.
So yes, I see lots of creative ferment in the innovation ecosystem, but a lot of it to me is forgetting the foundational principle, which is if you don't have unreasonable humans that are going to walk through walls for the next 10 years to fight a fight they think is worth fighting, you got nothing.
Yeah, and I think that is the key there, is understanding that, because what I was thinking about is, like, some of these larger funds are having their seed division that they write these small checks.
See, that's smart sourcing. The Scout Fund's a smart sourcing, right?
Yeah.
Which is they do have a network of people, and they have more money than they know what to do with. And not all of their network of people have the money to write checks. And Madrone upstairs, they have this, right?
Yeah.
Which is we're gonna let you write some small checks on our behalf.
Yeah.
Because really what we're doing is we're renting your network and we're giving you some economics to go and scout stuff for it.
Yeah.
And because the checks are so small, we don't mind if there's breakage there.
Yeah.
And because you realize in a venture fund, your time and your money have to go in. So the bigger your fund gets, the bigger the checks you got to write.
Yeah.
If you can't find a way to break bulk, then you inevitably keep drifting up market, because the desire in money management is to always raise more money because you get more fee.
Sure.
So if people will give you the money, you generally say yes, and you take it, and you get too big, and then you're like, oh shit, we've drifted away from the work we wanted to do.
We've lost our model.
Yeah. And the question is, does a scout check translate into a Series A? I don't know the answer on that. I mean, Madrone probably does. Like, how many of their scout checks do they get first bid on?
Yeah.
I don't know, but that's the bet.
Yeah, but that's the bet. Yeah, absolutely. And I think, one of the things that we as founders, when we're hunting for money, right, we forget is the tenets of your business. Like, if you're a small fund, there's certain things that you just described. Geographic location is important, for God's sakes. It's really important.
I mean, that's where the work happens. The first leg of the work, like, now Remitly is a global business and they've got 800 people worldwide, but that didn't start that way.
No, exactly. It was Matt and a few guys.
Right.
Yeah. So I think that's important for the founders to understand, is that angel investors, early stage guys like you, they're most of the time going to be doing someone within 50 miles of where you're at.
Yeah. And some of that's just like that's what I believe.
Yeah.
And some of it is laziness and selfishness, right? It's like, I got kids at home and I don't want to be on a plane all over hell and gone. Like, I want my work to be in my hometown.
Yeah.
And so.
Yeah. Well, and then if you think about, like, even like Kansas City or Denver, or these third tier cities or fourth tier cities. Yeah. I mean, the angel investors. They're not going to come to Seattle. They're going to be in Denver.
Right. Well, and you should. So the question I always ask myself when I see a Bay Area deal is, why am I so lucky? Right? If there's a deal coming to me from a market that's
huge,
and I'm not that well connected, and there's a lot of money, and you want my money, and so what's wrong? What's broken about you, right? And that's the question that anybody should be asking. If a deal is finding them in a way that it probably shouldn't, scratch your head.
Yeah. Yeah, there's probably something weird going on.
Yeah.
And also, I forgot to mention this. If you have any questions whatsoever at any point in time, just raise your hand and ask them. You're not going to interrupt me or Chris at all. So feel free to just raise your hand. Go ahead, Matt. Matt, you should connect with me on LinkedIn, by the way.
Mark.
Oh, Mark, sorry.
And I did.
Awesome.
Thank you. So I'm curious. It seems like there's some people who are kind of questioning, do I try and bootstrap, and some folks have had some success, I think, especially in B2B, with kind of getting some early revenue and because the economics of starting the business have gone down, you can actually get to profitability maybe even at a fairly early stage. Yeah. Obviously, you're not going to grow as massively fast, but there's organizations who are doing that. And so I'm wondering, can you talk a little bit about the gray area between, like, full-on bootstrapping versus full-on, going through Series G with an IPO? Like, what's the gray in between that?
Yeah, I would say there is very little gray. And what I mean by that is it certainly makes sense to create as much forward progress as you can before you try to raise money to strengthen your negotiating leverage. But I think the venture pathway and the bootstrap pathway are divergent in every way, from a culture standpoint, from an expectation standpoint, from a like everything about the way you build an org to be a lean free cash flowing business is different from how. So and what I'll use the positive example, not from a value standpoint. Venture capital is a dominant seeking industry, right? And the goal is to not be a contender, to be a player, to capture some share. It is to be the first and the best in whatever you choose to do. And that means inevitably you are investing very aggressively in capabilities, in team, in go-to-market, way ahead of your free cash flow. If you want to build a business on free cash flow, you by definition cannot pursue a dominance strategy. Because your number one priority is staying alive and preserving and funding stuff for cash flow, right? So think about all of the cascading leadership decisions that you would make differently if that were your high order management priority versus winning. And it's not that one is better or worse. It's just a choice. And most of the quote unquote winning crashes and burns, because that's the downside of dominant. Like usually only a couple can win in a dominant seeking strategy. And so it mostly doesn't work. But when it does work, it's really fun and it's really exciting. Everyone has a good time and probably people make money. So I think it's perfectly rational from point zero to say, look, I'm going to get my first 100K in revenue and ship a product because I'm going to be in a much better position when I go to raise money. Because like, look, I got 5 people who want to give me money because I've done so much and my product's so awesome and my early customers love me. But once you get on that train, you can't toggle back and forth. And really, if you run too far as a bootstrap, you basically have made it almost impossible to cross over.
Your culture is different, night and day.
Yeah.
I mean, that's the culture changes.
Yeah, it has to. Right?
Yeah, exactly.
Because the purpose, like if an organization needs a purpose, the purpose of the organization, the why that you show up for and your employees show up for is going to be different every day, depending on which of those you choose.
Yeah, and I think one of the things I've seen is you bootstrap for a couple years, which to me maybe is a little long, right? And so your culture starts to be built on that, right? And you may have 20, 15, whatever employees, and then you get a check for $1 million, and the check says you got to grow fast. Like now it's fast,
right?
And that's a different culture. It's a different mindset. And you, as a CEO, you sometimes forget about that.
And
you got to change people's minds.
There are stories. Like I think Atlassian is one of those stories where they grew it quite a ways before Accel somehow wormed their way in there and wrote them a check. And they ultimately took it public. Like they did cross over, but I think those stories are the exception that prove the rule.
Yeah, absolutely, definitely. And when we're talking about funding and getting checks, Chris, what is the thing that? What's the bite you in the ass thing that you see entrepreneurs do? When they're talking to you about raising money, like what's the thing a couple things that just like, dude, those are you shouldn't be talking to me, or you said the wrong things, or like they're just things that you just put your foot in your mouth, those kind of things where you just shouldn't do.
Right. I mean, I think I'm a very early stage investor, which usually means there's not that much to show. Like it's not a fact based. It's a human choice. So you're betting on the integrity and capabilities of that person. Anything that has a whiff of dishonesty, misrepresentation, lack of integrity, like it's a 10-year journey.
Yeah, this is marriage.
So anytime you and that's why people when you due diligence is like you think of it as like a data room or your financial model. It's not that at all. It's triangulating on you as a human being and trying to figure out, are you a high integrity person? Do you do what you say you're going to do? Do you take responsibility when you screw up? Like it's the basic human capabilities. And you can't always figure that stuff out. We've been wrong. I got that wrong.
Sure.
But if you can't trust the person you're writing a check to, nothing else matters. Yeah. Absolutely nothing else. And so anything where you're like stretching the facts or over-representing a deal, like oh yeah, we just closed a deal, and if I happen to know the company, I call them and be like, so did they? In fact, I did a diligence question for a fellow investor here in town. He said, hey, we're looking at a deal and they represent something about something that's happened with one of your companies. Can you check for me? And I emailed the CEO saying, this company is representing X. Did it or did it not? And I won't tell you how it turned out, but it's like people can find out. Yeah. So just don't make shit up. Yeah. That's number one.
Yeah.
And then we talked about the coachability thing,
sure.
right? Which is when pressed, do you get defensive and harden, or do you like expand? Do you learn? Do you engage?
Yeah.
Because your success as a founder is the ability to adapt and chuck and jive. It's not to be right today. You're wrong. We're all wrong on day zero. But if you can't learn your way to being right, so the intellectual agility with which you can take feedback and process it and have it make you stronger is sort of probably the next thing.
And so I think the critically important thing that you just said there is, it's all about being a human, man. It's not the idea is secondary.
What? And again, I'm broken record.
The idea is, it's not secondary, but
it is. That's why I get hung up on people who are like, oh, well, like I'm going to come up with ideas and I'm going to hand them to somebody else to implement. It's like, it doesn't work that way. It's the somebody that matters, because the idea is going to change and it's probably wrong. And it doesn't. What you need is someone who will walk through walls, because they're so committed to building a thing that they care about. Yeah. And I don't think you can make somebody a founder. I think founders discover that that's who they need to be, and then they go figure out where to put that energy.
And I think one of the things that, I'll get you in 1 second, I think one of the things that is also that I say almost constantly is, I know your idea is wrong, I just don't know where it's wrong.
Yeah.
I know it's wrong. I mean, because they're all wrong to start somewhere. It's just we got to figure out where the wrongness is, right?
Right.
Yeah, and that's the case for everyone's idea in this room. It's wrong somewhere. I'll guarantee you. I know it's wrong. Like your financials are wrong. Like I know that. Go ahead.
Since we were talking about trust, I recently had a conversation with an angel in Seattle who specifically mentioned that that Founders Co-op was the most ethical firm in his opinion in Seattle.
That's very flattering, but
that
I
was
won't
his
ask
brother.
who it was. But
that was his brother, I'm sure.
To me, that is the highest possible praise.
Well, my question is, do you feel like that was hard to do? And if so, how did you do it?
That's just Chris.
So hard to do, it's sort of is
hard to make it that way. Is that what you're saying?
Yeah.
Well, I guess
hard to create their reputation.
Or how were there bumps that you had to avoid, or was it no, this is just my natural way of being?
I mean, have we made mistakes along the way? For sure. But I think if anybody gets credit for that, it's my parents, right, or my partner Aviel's parents, because they were the ones who helped us figure out the difference between right and wrong. And if you think that life is a long game and the point is to keep playing, that it's not a winning or losing, it's how do I stay in the game? You, as best you can, try to do the right thing as often as you can, hopefully all the time, and probably none of us is capable of that, but as much as you can. And if you do that for 10 years or 20 years, or I just turned 51 last week, it adds up. Like everything in life compounds. Whether you're an asshole, it compounds. If you're good to people, it compounds. So just choose the things you want to compound in your life and lean into them. That's all I would say.
Yeah, and that's what's worked. That's what's created that integrity.
Well, it's not like we've got it all figured out. We make mistakes. We're a teeny little fun, and not clear that it matters to anybody but me and my partner and my family. But I love what I get to do every day, and that's what I care about.
Yeah, totally right. And in the process of finding, because you're seeking deals, and obviously
tonight, in fact, if you guys want to pitch me, I'm all ears.
It's not like everything just shows up on your front door, and here it is. What are the things that you look for when you're kind of, poking around for deals? What are the things that just makes Chris curious about it or intriguing? Or what would make you come up to say, hey, Mike, tell me more about that thing, or what is it that?
Yeah, and part of this is just investor talk, right? Which is after a while you get a sense for things that have scale in them and things that don't.
Sure.
And there's lots of really cool things, cool technologies that will make life better for a set of people. And the hard part is my job is to turn money into money. Yeah. And I've gotten clearer as you go through it, which is I don't get to keep doing what I love to do if I don't make money from my LPs. And there's only so many ways that you can do that. Yeah. And so the things that I get excited about are things where the founder clearly knows something, they know, and the Peter Thiel is kind of an annoying guy, but his insight, which is everybody has a secret, and it can be a secret in plain sight, but the founder believes they know something, they believe something that's not obvious to other people, yeah. and that's the thing they're going to go do, and that something has the potential to fundamentally transform the way people live their lives or businesses do business. So it's not enough to have a secret. The secret has to have leverage in it. And I think that's the part that a lot of founders get frustrated with us and we say no, is it's not that you aren't right. There is a business here. It's just not a business that's going to make my business work, because it doesn't, and we can be wrong about that too, but I don't believe that business has sufficient lift in it to make the math in my business, which is difficult math, work out.
Yeah, and I think that's super important for everyone to understand is VC math is different than, I call it normal math, but there's certain things that you have to do as a VC, otherwise you can't, like you say, you got to make money. So certain things you have to say no to some of these ideas, although maybe a great idea, maybe a great founder, it's just not big enough to make a 5x or 8x or 10x.
Right. Or at least I don't think it is.
Well, I don't think
I'm
it is.
wrong.
And you're
Right.
wrong. Yeah, you're wrong. You're
Right.
like, you're wrong too, but yeah, go ahead.
Yeah, could you actually go over kind of how you think about the math from your point of view for the fund? Because I'm kind of curious.
Yeah, so if I'll give you a,
repeat that, Chris?
in fact, I even have there's a blog post I did quite a while ago that has a Google Sheet attached to it, and I think it's called "Why Are VCs Greedy Bastards" or something like that.
Is that your Crash Dev site?
Yeah, so crashdev.com is where my personal blog is.
Crashdev.com.
And there was a fun comment thread on it like that. So if it's worth going back, and like that's the long form version. The short form version is you are a minority investor in illiquid private shares that either are worth something or zero, and you, as the first round investor, you can invest a little bit more, but like my fund is finite, so I can't keep putting money to things that work. So I suffer the same kind of dilution that founders do over the trajectory. So if you think about owning a fixed pool, a small percentage of ownership in a fixed pool of things that you get diluted to over time, and so like my last fund was 25 million. If I don't turn that into at least 75 net to my LPs, they won't give me money again. So with all the breakage, with the minority ownership, with the dilution, turning a 5% stake in your business into 75 million bucks, do the math. 20 times 75 million is $1.50, right? So you have to, terminal value has to be $1.5 billion if I own 5% for me to return my fund on your deal. And the math just like it's hard. Like the fact that they raised 300 upstairs, I'm like, okay, you're nuts $1 billion. every time. Like,
every time.
Holy cow, that's a big lift, right? And Matt McElwain's a phenomenal investor, and they're doing it. Yeah. But I'd be terrified to have to give people back $1 billion every 3 years. That sounds hard.
Well, plus the pool is smaller. The ideas are smaller because they have to be $1 billion ideas. Like you can take a $500 million idea and be okay with it.
Well, and because most things fail, particularly at the early stage, you have to believe that any single deal you do returns the whole fund. And if you don't believe that, you don't write the check.
To build on that, so when you think about the business KPIs invested in companies really early, how do you think about like metrics like growth versus revenue versus sizing a market opportunity, which all are, can be worked together, but all very different based on where a company's at in its stage?
Yeah, I think we probably think more about the culture and habits than metrics, which is, does someone understand how important the go-to-market is? Are they disciplined about building a go-to-market motion? Are they targeting the right people? Do they know how to close? So a lot of it for us, because you don't have millions of dollars in ARR, it's like, tell me how you think about your pipeline. And like, what are the active prospects you're working right now? How long you've been talking to them? Like you can come at, and if they're really organized in everything about how they think about product and engineering and go to market, you're like, look, I might not have all the answers. Like the numbers aren't but I know they're thinking about it the right way. And a lot of founders or founding teams, they're really strong in some areas and really weak in others, and that's okay. Like you can shore that up with hiring. But I think people who think they have all the answers, but clearly aren't thinking about whole categories of how to build a business, the blind spots can be it's not the positive facts, but it's the blind spots and the negative facts as much as anything that could make you be like, I think we better not do this one.
Yeah.
That makes sense.
Hi, Chris. Thank you very much for your talk. When you're looking at some founders who've got a good, promising company that you might want to invest in, what are some things that people might not tell you that you really wish they would have told you?
The bad things? Or just things?
Good things. Like if you wanted to make a decision, you might pass up on a company if you didn't know something positive about them. What do you wish they would have told you that you really wanted to know about that company?
It's a provocative question, and I'm trying to think if I actually have a good, like a useful, well-informed answer to it. Because most of the things that people don't tell us are things we wish they had told us.
Yeah, exactly. It's like,
Yeah, questions we didn't ask.
We're gonna be billionaires.
Yeah. I mean,
Questions
so
you didn't
one,
ask
and,
were
and I think one, and since our sponsors and co-hosts tonight are recruiters, one of the hard parts is building a team. And so a question that we've gotten smarter about asking is, who are your first N hires? And have you already identified who those people are? Because in many cases, a founder's like, look, there's just 2 of us right now, but I've already preloaded our first 5 hires. I can tell you who they are. I can show you their LinkedIn profile. They've already agreed to join. So that's something which might not come up, which we think about not only how do we make a bet on this team of people, but how do we get from 2 or 3 people to 10 or 15 people? That would be really useful to know, because building your team quickly with quality is something that every startup struggles with.
yeah, hiring roadmap, having a hiring roadmap,
Yep.
which actually is not something that is intuitively done by most founders.
Right. And not even a roadmap, but actual candidates identified who are sort of halfway out on the edge of their seat, ready to
Yeah,
do
like
it.
ready to sign on the deal. Where is the where do you think the industry is going for? And I'm talking about Seattle.
Mhm.
Okay, I want to say specific to this geography. Where do you think the lack of money, which is getting better, this early stage early stage money, and angel investor money, where do you think it's where do you think the growth is going to come from that, or for that segment? Like, where are we going to get more money in that segment?
Right. So I don't know the answer to that.
Okay, that's fair.
Yeah, I think, again, there are, so actually one thing that's interesting is, because on our last fundraising cycle, we had more
Chris,
limited
when
partners.
did you raise that money? Was that
So
last summer?
we did a first close in January of 18, and we finally wrapped it up in early this year. We've been investing out of Fund 4 since January of 18.
Okay.
And in late in that cycle, we got more people joining us as investors from other geographies. And there actually is an interesting groundswell of people who actually have identified the same thing that we believe, which is certain geographies have gotten overfunded. And so the Bay Area, grossly overfunded. New York, probably overfunded. LA, for its capacity, probably overfunded. And I think a lot of these people are looking around saying, where am I not hunting where there's, and we love, because like LPs who aren't just following the herd, but actually thinking original thoughts, more rare than you might think. And so we lucked into kind of a pocket of folks that were thinking this way.
Yeah.
And they've now started to introduce us to their friends who are also looking for edge, for alpha, right?
Sure.
So it's possible that there are more people waking up to what's happening in Seattle, because it's always like IPOs are a lagging indicator,
Yeah.
growth rounds are a lagging indicator. You
Yeah.
kind of got to be on the ground to see it. But we got exposed in the last year to more out-of-town money who was like, there's something special going on in Seattle. It may be that that's going to lead to more stuff happening here. We hope that it does.
Yeah.
So, but
That's interesting, though.
Who can
That's,
say?
that's good to hear, right?
Yeah.
I mean, that's a huge positive sign.
early and fragile. Right? Yeah, right. Don't take any, particularly with an election year coming, like who knows what's going to happen. All bets are off, right?
Yeah. Well, exactly. Say no more on that one.
Yeah.
Go ahead.
So, changing subjects a little bit, from the moment you first get a pitch from a company, what's about that, if you, in the end, give them money, how long does that process usually take?
So there's the getting to a yes, and then there's papering the yes. For us, because there's just 2 of us in the fund, and there's not that much to diligence because there's not much to it. Usually one of us will take a first meeting, me or my partner. If we like it well enough, we'll kick it to the other one, saying, I want to get your 2 cents on this one. That usually happens within a week or 2 at the worst if we're traveling or busy. And then we try to figure out what questions we need to answer. We'll come back usually with a follow-up with like, hey, we'd like to meet somebody else in your team that we didn't get to, or we'd like to talk to a customer. But that's probably it's 2 to 3 weeks from first intro or first meeting to either we think we'd like to do something here, or no, this isn't a fit for us. If we get to a yes, the next question is, are we leading the round or are we building a syndicate? If we're just doing it and being like, here's some money, go, we can do that like within 24 hours. If they need more money, if they want to raise 2 or 3 million, our first check size is like 250 to 750. So in some cases, we'll just be like, here's 500K, go nuts. And we'll talk about the next raise later. But if we need to build a bigger round, we can say, we'll commit this amount, and we think this is a price range in which we'd be comfortable investing. If you're okay with that, we'll pursue. Then we have to go out and corral other co-investors that we like to build a syndicate. Then we have to get the lawyers involved and paper the whole thing. And the rest of that can take 4 to 6 weeks. So it's a squishy answer to your question, but our decision is quick.
Weeks.
Because there's just 2 of us and there's not that much due diligence.
How'd you guys meet? Like, why did you guys come together
So,
to do this?
so Aviel was a CEO in my first first portfolio. So I invested in him, saw him build a business and raise money and go through twists and turns. He became a diligence partner for me. He was still running his company, but he would help me with technical and product diligence for both the fund and for Techstars. And then as he was getting ready to exit his business, we were talking about does he want to start another business or want to do something else? And he's like, no, I actually think I want to do this full time. And so we had a conversation. But it's been a 10-year rolling opportunity to work with each other. And like partnerships are hard. And this one still, we could run into trouble. But I feel much better about having had a lot of runtime with him and vice versa. Because venture funds, just the mechanics of them, they're 10-year funds. So the life of each fund is 10 years, usually with two optional 1-year extensions for liquidity reasons. And so anytime you raise a fund with somebody, you're stuck with them. I mean, they last longer than most marriages. And you ladder funds. So every 3 or 4 years, you raise a new fund. And so you're every 3 or 4 years, you're saying, do we want to be together for another 10 or 20 or 12 years? That's a big commitment. It's not something you do lightly.
I'm curious about the connection and relationship between the Techstars and your fund. Do you guys like cooperate, or do you have foot in both of them with the teams that pitching at the Techstars? Would you pull them to the fund?
Great question. So for those who didn't hear, it was the relationship between Founders Co-op and Techstars or Techstars Seattle. So that's evolved over the years. In the very beginning of Techstars Seattle was a fund. The investors in Techstars Seattle were Founders Co-op, Madrona, Vulcan, Trilogy Equity Partners, Maveron. I think that's most of it. So we as a fund were investors in Techstars Seattle. We would also invest in, I led the seed round at Remitly and Outreach, which are both Techstars. Well, Outreach is kind of half a Techstars company, longer story there. So as a fund, I was investing in Techstars companies that I had also sourced and developed through Techstars. It's confusing, right? Yeah. After a while, as Techstars got bigger, we were like, okay, we need to clean up the rules of engagement here. And the rules that we came up with, which we observed for as long as I was running both programs, were we won't bring anything through Techstars that we're already investors in, so we won't double dip. We can't invest in anything in the program. We can't lead invest in anything in the program. We have to wait for other investors to spark rounds, and we can join rounds. We're not barred from investing, but we have to wait for the market to speak. We can't lead anything until 90 days after programs. We have to let the market decide, do they want to back this company or not? And if the market doesn't, then we can step in and lead. The only way we could not do those things is if I went to David Cohen and said, David, I want to break the rules and here's why. And he said, okay. And we did that a handful of times, but for the most part, those were the rules of engagement. But it was still confusing. It's much less confusing now that I'm not doing Techstars, which is I invest in early stage startups in Seattle. If they happen to be in Techstars, fantastic. If not, fantastic. The rules are different. But that's how it went for a long time.
Yeah, and that does make sense. Go ahead, Mark.
What's the, you just said you invest in early stage. So can you give us an idea of the beginning of that and the end of that for you?
So the language about early stage has gotten really mushy in the last little bit. In the current term of art, we are a pre-seed and seed stage fund. And that usually means pre-founding to, I don't know, $500K in revenue, if you want to use that, or early product in market would be the tail end. Because usually, if you have a product in market and you're generating revenue, you have line of sight to a Series A, or you're not going to raise a Series A. And if the Series A market is already looking at stuff that we're looking at, we're too late.
So is there anything that's too early?
No, I mean we have committed to invest in things where the people were still working their full-time jobs. They hadn't yet incorporated. They have to incorporate for us to actually give them the money, because for fiduciary reasons we can't give people money without it. Yeah, but no, we are comfortable investing in teams before they have built anything or shipped anything. We would prefer they have done a lot of customer development. That's the one thing we do care about. Is have you talked to lots and lots and lots of people about your idea and gotten feedback and adjusted your thinking with the feedback? So we're kind of uncompromising on that. But shipping product and selling stuff is not a requirement for us.
Yeah, but having that customer thesis of knowing what is needed is critical.
Yeah, and having had customers beat you up about it and be like, no, you're wrong 7 different ways, and here's what I really need, and to have heard that. And because a lot of people do customer development, and all it does is hardens their conviction that they're on the right track.
Yeah, they're just getting pats on the back about how great their idea is.
Right.
Where did I see a question? Did I miss something? Dante?
So if you guys invest if you're first in on a early company, and that company wants to produce something with like Y Combinator and a safe.
Mhm.
Like, do you guys have problems with that because safes are not?
So we're mostly instrument agnostic at the early stage. Like we obviously prefer it to get to preferred equity when the real money starts to come in, but often for speed, like we have 4 companies where we invested on a safe or cap converter or some instrument, whatever the founder was comfortable with. Then they went to YC and raised out of YC, and in many cases we've added more money in that round. And then a year later they get to a preferred financing, and we roll over. And so at the getting dogmatic about structure at the early stage is usually not that productive. Getting the money to the team in an instrument where everyone feels like it's fair and they know what they're getting. I mean, I think the complaint or the objection to safes and cap converts is that they ladder and dilute in a way that founders often aren't aware of. So the conversation you have to have is like, we're fine raising on a note. I wouldn't raise any more than X on a note, and I'd be careful about managing your caps within a band, because you might not like the way those notes flip when they flip. And there's really good tools out there that people can see what happens. But we're not hung up about it. We've seen it where founders are like, holy shit, I sold half my company, I had no idea. And that's a bummer for everyone.
Yeah. And one thing he was talking about was he didn't really say it, but it's convertible note and a safe note. Those are 2 very, very normal documents that we use to raise early stage stuff. Back.
What advice would you have to somebody starting out in angel investing, especially in really early stage companies?
Oh, for as an angel investor, like you're okay.
Yeah, I mean, I think the math on angel investing is you have to, like in anything, you're building a portfolio. I think many angel investors are starting out thinking like they heard a story about a friend who invested and it turned into a ton of money. I would say the way to begin in angel investing is to commit yourself to a program of angel investing, which is I'm going to invest a fixed amount of money every year, every quarter, and I'm going to do it for at least 2 or 3 years. And so you give yourself the discipline of time diversity and deal diversity. So you build your reps and you build your muscles. You don't go hog wild and write a bunch of checks in a hurry, because you're going to be learning along the way. You're going to be building portfolio along the way. So thinking about it like a fitness routine, which is I have to commit for a longer period of time and I have to do it in a structured way where I get better at it over time, is the best way to think about it. If you only, and there are people who do this, is like if you only ever invest in the thing that your golf buddy tells you about and you do it once every year or once every couple of years, you're not going to learn anything from the experience. And there is a craft to it, right? In terms of getting better at evaluating opportunities and what you're a fit for. So I would say just like do it. By all means, do it. We need more angel investors in town. But do it with the intention to do it as a recurring part of your life that you do in a structured way. And think of it as building a portfolio and building muscle. And you'll be super valuable. Like you'll be one of 10 investors in Seattle that do it with real intent. And you'll add a ton of value to the ecosystem.
And people want you as an investor, which was key, because there's people that wrote not any names, but there's people that wrote lots of checks real quick, and no one really wants them as an investor because they really didn't learn anything. They're just money. It's just like you need something up here. You want to add value as an investor, by the way. It's not like as a founder, you want to be bringing people that have some knowledge into the equation, not dumb money, so to speak.
But you'll also have more fun.
Do angels typically go in on their own at the beginning, or are they typically wanting to get into a network or some other way that they're kind of learning from other angels?
So co-locating the words angels and typically is a dangerous thing to do, because investment funds are just partnerships with people, but they at least have to do things in a way that's legible to their LPs and other folks. Angels are just people mostly doing stuff by themselves, and they cover the entire spectrum of incredibly rigorous, disciplined, well-connected, value-added, thoughtful, helpful people to incredibly obtuse, destructive, every bad thing you can imagine, not because they're angel investors, but just because they're people. So talk to your peers who are raising money and network with each other and try to find out who you'd want to take money and who you wouldn't from. In the same way that you want to find out who you want to have dinner with or you don't want to have dinner with, it's the same kind of thing because they're just people.
So your LPs, is that more institutional, or are those angel investors who are part of your fund?
I'll repeat that.
Yeah. So the question is that the limited partners, the LPs in our fund, who are they? What kind of money are they? and it's a mix. So by dollars, it's probably half or a little more than half high net worth individuals who made their money in tech, probably also angel invest, but because angel investing is a discipline, and they either don't have time or for whatever reason they're like, look, I might still write the occasional angel check, but I want to be invested in this community, in this asset class, and I trust you guys to do it with at least a chunk of my capacity. The other half is what I would call institutions or pseudo, so like the state of Oregon is an LP. There are some family office investors, so like people who are they have a team of people who manage their money for them because they're that wealthy. So it's managed professionally, but it's still a single individual. And then there are some family foundations, and so it's a pool of capital that's managed by professionals, but there's a family behind it. We don't have any pension or endowment investors, so it's individuals, family offices, and family foundations. And the state of Oregon's kind of an outlier, which I can explain, but they do it for return, but also because they want to invest in the geography, and we have a very geographic lens on innovation.
To follow up on that, are the LPs typically public, and should a founder kind of understand who they are when they're evaluating the type of partner that can help them in their industry, or is it much more the people managing the funds?
So some funds market their individual LPs as leverage because it's sort of their network, and particularly if you have fancy names in there, it's like, but the reality is most of those people they didn't sign up to do work, right? Yeah, and so that's mostly marketing and not a fact. In the early days, we had our LPs listed on our, and after a while, it didn't feel honest,
Yeah.
and there were too many of them because the list got longer, and so finally we're like, no, that's not really true. And if you're getting investment from us, you're really getting investment from me or IVL or us together.
Not that you don't leverage some of that sometimes. You might call and say, hey, can you make an introduction?
Yeah, no, totally. And honestly, so the leverage for a fund like ours, it's your LPs are leveraged because they've entrusted you with their money, and as a result, they want you to do well. And so if you call them and ask them for something, they'll be like, oh, that's in my interest to do, right? But even more importantly, so between Techstars and Founders Co-op, we've been a part of over 200 starts in the Northwest. So we've worked with a lot of founders. And your comment is gratifying. If your founders like you and believe in you, when their friends ask them, hey, who should I raise from? They can be like, well, I worked with these guys and they did right by me. So the leverage that we get is, surprisingly, we get a lot of leverage from the founders we backed, not just from our money. Yeah.
I have a question regarding timing of the rounds. So when you're guys raising, let's say the team is raising seed round from you, what is your expectation in terms of timing of when the next round should be and the round after that for you to return the investment for the LPs? Because the founders could have a different view of how aggressive they need to go to the market, and the amount of investment will depend on that.
Right.
But let's say if they come to the table we were planning to really raise the next round in like 4 or 5 years, and we need $500,000, and you say, well, that's too slow. You'd be like, well, then we'll need to triple that amount, but you guys can't cover the whole thing. Like, what is that relationship in that?
Yeah. So the question is that what's the expectations for entrepreneurs and for us as a fund and for other investors about the sequencing of when we invest versus when the next round happens, and how do we plan for that, and how do we help entrepreneurs plan for that? The short answer is the venture community. Like, there's a lot of kind of basic rules of thumb in venture. And one of the rules of thumb is, so like every round, you're going to sell probably between 20 to 30% of your business. Doesn't matter if it's a growth round, it's a seed round, like that's, so the Red Queen problem is you're always trying to outrun your dilution. If you don't increase your enterprise value by at least the amount of dilution you took, you're treading water. Your employees won't like it. So you have to significantly increase the enterprise value of the business. And so every round you want to take just enough capital, because it's expensive capital, to achieve the goals, to increase the value, to get the next round of money at a higher valuation. Like, that's the ladder you're climbing. Most venture investors will say, look, you have to have at least 18 months of capital, because it's 12 months of performance and 6 months of fundraising and contingency. If you raise any less than 18 months, they're gonna be like, look, you're gonna be back with your hat in hand and not have achieved anything, so don't do that to yourself, right? Any more than 18 months, and maybe 24 is the outer bound on that, you're probably selling more of the business than you should at this price. Because if you haven't at least doubled the enterprise value in 24 months, you're probably not going fast enough. You're going to fall off the venture wagon. You're not going to get that next round of money. So the banding is surprisingly predictable no matter what you're doing. Less than 18 months is scary. More than 24, you're probably screwing it up. And the expectation is you're going to raise again within 12 to 18, because with at least a 2x on enterprise value. Like that's if you're doing it right, that's how the game works. And you can deviate all you want, but just know that the system is going to keep pushing you into that normal path. And you deviate only because you outperform or you fall off the wagon.
One more question if there is. One more question. More questions. Awesome.
We did it. We wrung it out.
Totally. That's awesome. You did a great job.
Thank you guys for all the questions. Thanks for being here.